tax law, I think that um, I think that we have made already some important progress in understanding the basic principles of income tax law. We started with the foundations of tax law: what is tax, what is income, and then we went into the scheduler system. We talked about um, various kinds of heads of income, salary, and we income from house property, and then we came to um, business income. And in business income, we discussed what is the meaning of the difference between capital receipt and revenue receipt. We went through a number of cases, culminating in the Mahindra case. And after we discussed the Mahindra case, we realized that the differences between capital receipt and revenue receipts have to do with a number of factors, including the kind of receipts or the kind of income that is received by somebody. And we discussed those kinds of possibilities in especially in the context of loan waivers. And we said that the character of the payment received in the case of, or the benefit character of the benefit received in the case of a loan waiver, depends on what the loan was taken for. If it was taken for a capital asset, then in the Mahindra case, it was decided that the waiver of the loan will result in a capital receipt. I must caution, though, that as we know, and I said towards the end of our session last time, that the uh, Indian government has amended Section 28, Clause 4, which deals with perquisites. And the amendment states that perquisites need not be in the form of it could be in either form. It could be in money's form or money's worth. Um, and that has led to some doubt or ambiguity about whether a loan waiver can be considered as a perquisite. The issue is not very clear. Um, I think that on the whole, the Mahindra case supports the proposition. Just give me a second, please. Just give me 1 second. Sorry, I'm back. On the whole, the Mahindra case supports the proposition that um, the loan waiver for a loan taken to acquire a capital asset would be a capital receipt. But the revenue might be able to make an argument that the deeming provisions in Section 28 uh, might well encompass loan waivers. We don't know yet. I think it's something that we'll have to see as the issue reaches the courts. The one argument that can be made is that in 28 Clause 4, let me just read out the provision. 28, Section 28. Section 28 says, since Section 28, Clause 4 reads as it reads today, it says the value of any benefit or perquisite arising from business or the exercise of a profession, whether convertible into money or not, or in cash or in kind, or partly in cash and partly in kind. Now, the revenue might say this is a deeming provision, as in, it doesn't matter whether it's a capital receipt or a revenue receipt in some universe, but as soon as it comes within 28 Clause 4, all those issues go away, right? And that the only issue that remains is that it's a capital that it's a perquisite. The taxpayer may well argue that the Mahindra case still stands for the proposition that loan waivers, especially for loans taken to buy capital equipment, are essentially capital receipts, and that even here, the value of any benefit or perquisite must arise from business. And here it doesn't arise from the business, it arises because of some loan transaction for capital equipment. The revenue might argue, relying on Ramniyam Homes, that the words used are value of any benefit or perquisite arising from business, not from the business. And from business means any receipt that comes into the business. Can be capital receipts, can be revenue receipts. So you can see there are arguments on both sides. And this brings me to an important point about this course that I want to alert you to. I've said this before, and I want to emphasize this again, that courses conducted at the National Law School have a different flavor and saliency to it. We are taking you through the foundations of whatever subject we teach you. It happens to be income tax here. And we are doing it in a critical and insightful teaching pedagogical manner. What this means is that we will often deal in ambiguities. Often there might be issues, tax issues in this case, but it could be any legal issue we're discussing on which the answer is not clear. What we expect the students to do in these situations is to do a careful analysis of the applicable statute. They must be clear what the statute says. A careful analysis and parsing of the case law. They must be well aware of what the case law says, not just the heading or the head note or the title of the case, but what the case actually states. How has it analyzed these issues? And then take a call on how to apply this to issues in the real world, where often the answers are not clear, where it's ambiguous. Sometimes our students tend to miss this because they haven't learned the law that way, right? And it's really important that we understand, we have a common understanding of what we expect from our students, right? What this means for you as students of tax law in this course is that while you come and listen to me in this class and you interact and engage with me, you have an additional responsibility, which is that you take care to go through all the course materials that we have prepared for you. Not just listen to us in the class, but actually read through those course materials. I don't expect you to have read those course materials before the class. I mean, I understand that. I mean, if you do it, it's a bonus for me, but I don't expect you to have done that before the class. But I do expect you to have done it after the class. Those course materials have been prepared with a lot of thought and consideration. A lot of hard work has gone into it, and a lot of thought has gone into it. You will not be able to take complete advantage of the course unless you actually read the course materials, right? So it's important that you do that. That effort I need from our students. Only then will you be able to take complete advantage of the kind of teaching and learning that we want to do in this course. Yeah. So that's where we are. Now I'm going to move on to my next topic, which is the difference between capital expenditure and revenue expenditure. But before I do that, any other questions? I want to see if somebody has any questions or comments, anything about the course, and then I want to say a few more things about this course, and then I want to move on to the difference between capital expenditure and revenue expenditure. So anyone? Okay, great. So the one thing I want to say in further is that this course will involve application of the statute in various ways. I have told you this before. You can either access the statute online, it's available on the CBDT website and on other government websites, or you can buy the bare text. You are students on the cusp of moving to the new legislation, but for all assessment purposes, we will only use the older legislation, which is 1961 Income Tax Act. Do not worry about the 2025 Act. From time to time, I may refer to the 2025 Act to tell you where the provisions are now, but that's not required for the exams. For the exams and for your assessments, you are held responsible to the 1961 Income Tax Act, which you must read whenever, and we go through some provisions or the other. We've gone through Section 28 here today. You must read those provisions very carefully. Again, you, of course, will read it in the class with me, but I expect you to have read it after the class as well. The second thing I want to tell you is that we often ask you to apply whatever you have learned to problems in the class. It's important you take that seriously as well, because that's what we expect you to do in your assessments. It's important. This course is not a merely theoretical course. It is a course that expects you to apply whatever principles and knowledge you have received to real life situations, and that's something that you need to be mindful about. All right, so now we are at a stage where we have understood what the difference between capital and revenue receipts are in the context of Section 28. And we are reading Section 28 because we are talking about the scheduler head income from business or profession, right? And today we want to begin this session, and the next session will be about the difference between capital expenditure and revenue expenditure. We'll begin with that question. We'll be doing some English cases today and an Indian case. And then in the next session, we'll do some more Indian cases on this. We do English cases and Indian cases because there's a common law of tax which is common to England and the UK and India, and therefore a lot of English cases are relevant to Indian tax law. So now we begin by saying this session is about capital versus revenue expenditure. May I ask the students, why is that distinction even important? Why are we even talking about it? Anyone? Please, either you can raise your hands and I can call on you. That actually might be the easiest thing to do, or you can write in the chat box. Remember, this is not nobody's judging anyone here. We are just, it's a teaching learning session, so we are just interacting with each other. It's just less tedious if we are able to interact with each other. Yeah. So anyone, please, if you can raise your hands, or you can write in the chat box. Why are we even talking about the differences between revenue expenditure and capital expenditure? Yeah, I see a number of students. Surely one of them should be able to tell me about this. Yeah, and yeah, so I think I got a chat box message from Dutt, who says that expenditures on account of revenue are usually partly or fully deductible. Expenditures on account of capital usually aren't. They may be amortized or depreciated. That's absolutely correct. That, thank you for this response. I have a question. When you say something is partly or fully deductible, anyone can answer this question. When you say something is partly or fully deductible, what does that mean? Indulekha says the effect of capital expenditure is not restricted to a single year, while revenue expenditure is restricted to a single year, which is the kind of the differences. That's right, Indulekha, between capital revenue expenditure. But my question is more basic. My question is, when you say something is deductible, what do you mean by that? That's not a difficult question to answer, I'm hoping. Yes. Okay. Yes, deductible means that is saying deductible means reducing income for tax purposes and therefore lowering the taxpayer's tax payable. Perfect answer. That yes, that is why we are interested. We are interested in this question because of something of a peculiarity of income tax that we take for granted. And I say we take for granted because think of other taxes that you know of, right? So think of GST, for example. In GST, we don't bother about deductions, right? I mean, when somebody sells you a chocolate in the shop and then adds 18% GST to it, that's the end of the matter, right? I mean, there's no question about how much expenditure you incurred or the shopkeeper incurred. Either you incurred as a buyer of chocolate or the shopkeeper incurred as the seller of chocolate on manufacturing that chocolate. Um, that's not a relevant question in GST. Right? It is a relevant question in income tax. Right? In income tax, you never impose a tax on a gross basis. You always impose a tax on a net basis. And what we mean by net differs from schedule to schedule, right? So in capital gains schedule, it means net means sales price minus cost of the asset. In your salary income, net might mean your salary minus standard deductions. In income from house property, net would mean your rental income minus repairs to the house. Similarly, in business, in the schedule on business income, income for tax purposes, business income for tax purposes means your gross revenues minus the deductions that are available for you in that business schedule, right? And in answering that question, when we say deductions, what we mean is usually that means you can deduct from your sales revenues, whatever you're selling, either goods or services, from that amount, you can deduct what is known as revenue expenditure. Revenue expenditure could be of various types. Revenue expenditure could be your cost of the goods that you're trading or the cost that went into performing those services. It could be the interest payments that you made on loans you borrowed for your business. It could mean anything. What it does not mean, though, and there's where Indulekha's difference comes in, it does not mean capital expenditure, which usually has an impact over various years, over a number of years, and therefore it's not appropriate for you to deduct the capital expenditure from your income for one particular year. And usually, as Dutt said it, it is depreciated or amortized over a period of time. You buy a building, and the building can last you 40 years or 50 years. You're allowed to deduct 10% of the cost of the building. I'm just throwing out a figure over there. You're allowed to deduct 10% of the cost of the building every year as depreciation or amortization. But where's the legislative basis for what I'm saying? Yeah, that's the question we should ask next. And for that, I want you to turn to sections 37, of the Act. And I'll just read out section 30. The way the Act is designed is that there are various deductions and expenditures that are allowed to the taxpayer between section 32 and section 36, right? If you go, between section 30 and section 36. So if you go to the Income Tax Act, beginning from section 30 to section 36, there are various deductions that are allowed. This is laid out in section 29, which says the income, I'm just reading out section 29, the income referred to in section 28 shall be computed in accordance with the provisions contained in section 30 to section 43D. And then there are each of these provisions deals with various kinds of deductions. We're not going to go into, this is a foundational course. We're not going to go into any of these deductions in any great detail, but you'll get a sense of what they are if you just look at those headings. Section 30 deals with rent, rates, taxes, repairs, and insurance for buildings. 31 deals with repairs and insurance of machinery, plant, and furniture. Section 32 deals with depreciation and so on, right? And then you have a general catch-all section, which is called as Section 37. And Section 37 says, and this is where we're reading it very carefully, Section 37 says, any expenditure not being expenditure of the nature described in section 30 to 36, and not being in the nature of capital expenditure or personal expenses of the assessee, laid out or expended wholly and exclusively for the purposes of the business or profession, shall be allowed in computing the income chargeable under the head profits and gains of business or profession. So I'll repeat, any expenditure, and there are two sides to this, right? This catch-all provision, or the residual provision you might call, has two sides to it. The first thing is it says that um, we are talking about now kind of a catch-all clause or a residual clause. We're not talking about sections 30 to 36. But it cannot be, these any expenses can be deducted provided they are not capital expenditure. So we'll have to first figure out what's the difference between capital expenditure and revenue expenditure. And the second thing is that this expenditure must be laid out or expended wholly and exclusively for the purposes of the business or profession. Right? These are the twin requirements. It should not be a capital expenditure, and it must be expended wholly and exclusively for the purposes of the business or profession. Now, if these two twin requirements are met, then Section 37 kicks in and you can allow for the expenditure. Right? So now let's see how this plays out in actual factual circumstances. Yep. So now let's see how this happens. So for that, I'll have to make a small presentation for you. I'll have to go to the slide deck. And let me do that. Before that, any questions so far on the discussion? Anything that you are interested in asking? Okay, good. All right. So now I'll share something with you. I'll share my slide deck. Right. Yep. Right. So just confirm for me, please, that you're able to see the screen and you're able to hear me. Anybody in the chat box, if they can please confirm, that'll be great before I move ahead. Great. Thank you. Thank you. Okay. So the first case we deal with is called as the Anglo-Persian Oil Company versus Dale. And this case is in your course material, and it's in note 18 of your course material. I think the page numbers are different than the ones I have and the ones you have. So I'm just telling you it's on note 18. And in this case, the question was, there's an Anglo-Persian oil company that decided to terminate its agency agreements with its agents in Persia. And the question was whether the large payment made by the oil company to terminate an agency agreement was a capital or revenue expenditure for tax purposes. And here the judges focused on whether the expenditure brought about an enduring benefit to the company's trade, akin to an investment in fixed capital. And they said, no, there's no such enduring benefit. An expenditure is considered a capital expenditure if it is made to bring an asset or an advantage into existence. And here they said there's no such thing. They just canceled the agency contracts and paid them a lump sum. So it's not a capital expenditure. And if you go to your note, and I'm just going to go to the note here. What you see are the facts in problem 2 in note 18. And then if you scroll down, I request you to scroll down to note 19. And if you just, we will not deal with Lawrence LJ's argument in note 19, but with Romer LJ. Romer is a judge. Romer's um, argument, and I'm just reading that out here. He says that it should be remembered in connection with this passage that the expenditure is attributable to capital if it is made with a view to bringing an asset or advantage into existence. It is not necessary that it should have that result. It is also to be observed that the asset or advantage is to be for the enduring benefit of the trade. I agree with Rowlett Justice J that by enduring it meant enduring in the way that fixed capital endures. An expenditure on acquiring floating capital is not made with a view to acquiring an enduring asset. It is made with a view to acquiring an asset that may be turned over in the course of trade at a comparatively early date. By floating capital, he meant, if you're buying and selling potatoes, potatoes is a floating capital. It's an asset, but it's an asset that you're using just to sell, right? Sell and make profits. Nor, of course, need the advantage be of a positive character. The advantage may consist in getting rid of an item of fixed capital that is of an onerous character. When the negotiations with Strick, Scott and Company are the agents whose agency contract was terminated. When the negotiations with Strick, Scott and Company that ultimately led to a cancellation of their agreement were first set on foot, the only reason suggested by the company's chairman was that the commissions then being earned by the agents were much in excess of the amount anticipated at the time the agreement was entered into. And it was merely a modification and not a cancellation of that agreement that was contemplated. I can find no indication that any enduring advantage to the company's trade from a capital point of view was being sought, nor was it suggested that any such advantage would be gained in fact. For myself, at any rate, I cannot see what other advantage will accrue to the company from the cancellation. The result could merely be that the company would be represented in the East, in Persia, by agents other than Strict Scott and Company, for it is obvious that being a corporation, it must have agents of some sort out there. Those agents could no doubt be employed on terms more favorable to the company than those contained in the agreement with the previous agents. And it may well be that the company could retain a greater measure of control over such agents than they would over Strict Scott and Company. Now, all this could lead to the economy and the savings in working expenses. Of any further advantage, then there is no evidence, right? So, except for the change of agents, and for all that I know to the contrary, the business of the company continued exactly as it was before the charge. So I cannot find any advantage or benefit, either positive or negative, accrued to the company, capital of the company by the expenditure. All the advantage or benefit that it brought seems to have been merely of a revenue character, right? So that's the ratio of the case that there must be uh, capital expenditure means expenditure that is made with the purpose of bringing an asset or advantage into existence. And that kind of asset or advantage must be for the enduring benefit of the trade. If that's not the case, it won't be capital expenditure, it'll be revenue expenditure. At this stage, can I just ask if people have got what I'm saying and on what the ratio of the case is, and that is there anything here that um, you may want to talk to me about? Let's see. Anything in the chat box? Um, no, I don't think so. Okay, great. All right. So, okay, I don't think so. Yeah, I don't think there's anything in the chat box. All right. Um, Now we go on to the next case, which is sorry. And now when you go to the next case is not about the difference between capital receipts and revenue receipts, but it's actually about the next case is not about the difference between capital and revenue expenditure. It's actually about capital versus revenue receipts. But I'm discussing that case here because it's kind of related to my previous point. This is a case called Oberoi Hotels versus CIT, which is a case that it's an Indian case, and I usually do this case or just point out this case to you just to notice the difference between the previous case and this case. Although, as I said, the Oberoi Hotels case is actually not a case about expenditure; it's a case about receipt. And in the Oberoi case, the question was whether a payment received by a hotel management company for relinquishing its right to purchase or operate a specific hotel was a capital or revenue receipt for tax purposes. And the court determined in that case that the money the SSC received for relinquishing its right to purchase or operate a hotel property was a capital receipt. And therefore, it wasn't taxed on it at that point of time. Now the law has changed. The court reasoned that this was compensation for an injury to a capital asset and resulted in a loss of an income source for the assessee. The only reason I'm mentioning this, by the way, is because you see, in this case, the person receiving it um, have it was considered as a capital receipt, and you can and I'm mentioning it because if you go back to the previous case, the Anglo-Persian case that I just now did, and if you ask what is the character of the payment in the hands of the agents whose contracts were cancelled, based on what the Oberoi Hotels case is saying, that would be a capital receipt. Because in the hands of the agent, not in the hands of the person paying, but in the hands of the person receiving, in the hands of the agent in the previous case, in the Anglo-Persian oil company case, it might well be that that relates to a capital receipt because it was a compensation for an injury to a capital asset. That agency contract was a capital asset, and it was a income source for the agents, and so they lost it. They lost their source of income, and that would be considered as a capital receipt, not a income receipt. Now, I want to caution you. That's the reason I'm mentioning this, of course, is because for the same payment, there may be a difference in character between the recipient and the payer. Right? For the payer, it might well be revenue expenditure. For the recipient, for the same amount of money, for the recipient, it might be a capital receipt. Having said that, I must alert you that, especially with regard to Oberoi Hotels case and these kind of cases, and even the Anglo-Persian case, the law has changed. Now, Section 28 has been amended, and Section 28 says that if I may direct you to Section 28, Section 28 says in Section 28, Clause 2, Section 28, Clause 2 says any compensation or other payment due to or received by a person, and you can see Clause C may apply in some cases. Any person by whatever name called. Section 28, Clause 2, Clause C. Any person by whatever name called holding an agency in India for any part of the activities relating to the business of any other person or in connection with the termination of the agency or the modification of the terms and conditions relating thereto. And of course, here in this case, this person, Section 28, Clause 2, Clause C will really apply only when this person is holding an agency in India. So suppose you're canceling an agency somewhere else, that may not work. But then you also have a catch-all provision in Clause E. So you have a Section 28, Clause 2, Clause E that says any person by whatever name called at or in connection with the termination or modification of the terms and conditions of any contract relating to his business. And if that were the case, then both in Oberoi Hotels case and in Anglo-Persian case, it might well be the case that Section 28 applies, and even the recipient would be the money received by the recipient also would be considered as revenue income and not capital receipts, right? So you can notice how legislatively the character of payments can be changed, even though the courts have said otherwise. Again, I'm going to stop here and ask if anybody has any questions, comments, anything that they want to talk to me about. Raise your hands or put something in the chat box, and it'll be 1 second. Let's see. Let's see. All right. Okay. Um, all right. So now we go to the next case, which is called Tucker versus Granada. It's a very interesting case. And um, well, how do I make you understand this case? Because this case, the facts are very peculiar in some sense, right? And the reason the facts are peculiar is because it's not a straightforward application of the issues that we have been talking about, right? Um, well, let's see. If you go to note 18 in your reading materials, you will notice the facts mentioned there. Problem one: Tucker versus Granada. Let me simplify the facts for you a little bit, right? These the taxpayers in this case, their business basically consisted of selling stuff at all these motorway service areas, right? Gas stations, etc. And they basically held they had a shop selling goods at these motorway services. You know how it is, right? If you go to a gas station, if you go to a petrol station in India, sometimes you'll notice there's a shop there that's selling stuff. It's very common in the West. It's becoming more common in India as well. And what usually happens there is that the person who's in that shop, who owns a shopping business, have actually rented that space from the government. Right? In India, it'll be the Indian Oil Corporation, for example. In the UK, it was the UK government. So the the what's happening here is that a person owns a shopping business, selling some groceries, etc., uh, and they have leased out from the government some land in the as part of the motorway services or gas stations. How are the rental payments done? The rental payments are a function of a certain formula. They say that from month to month, for leasing out the space, I'm going to give you a certain amount of money every month, right? And this rent consists of two parts. There is a fixed sum. Say I'll give you the shop the person selling groceries says, I'm going to give you a rental payment for leasing out the space in your gas station. I'm going to give you a rental payment of 100 rupees per month, which is a fixed cost, plus an additional rent, which is a variable amount, and that is calculated as a percentage of the business done selling groceries. The problem, of course, is when you say that I'm going to give you 100 rupees plus a certain variable rent, and that variable rent depends on a percentage of the goods sold in the shop. The problem is, what's the value of the goods sold in the shop, right? Because you'll end up paying more rent if you sell more goods in the shop. If the value of the goods sold is more. Now, the problem is, what do we mean by the value of the goods? Do they include the GST on it? I'm saying GST here because we have an Indian context. There, it was a question of tobacco duties on the tobacco sold. Do you include the tax component in the value of the goods? Because if you include the tax component, if your variable rate depends on the value of the goods and you include the tax component, then the taxes will increase the variable rent. The more taxes you pay, the more rent you will have to pay, the more variable rent you have to pay, right? And I think and this is an instance of how, when we discuss tax, we have to discuss a commercial context. The commercial context is they had agreed on a certain lease payment, and that lease payment was actually quite onerous in character. The conditions of the lease were very harsh because the variable rate depended on a value that included taxes. And if the taxes went up, then their variable rates went up. And that is not a really a good commercial deal for them. So they negotiated with the government. And the government was aware that this was a pretty unreasonable deal, although they were, the government which owned the property, which owned the land, benefited from this agreement. But the government said, yes, we agree that this is a bit of an unreasonable deal, and therefore we will waive that. We'll change the terms of the lease. We'll modify the terms of the lease, provided you give us a lump sum payment. Lump sum payment calculated on some formula, and that formula is mentioned it's not mentioned in the slide deck here, but it's mentioned in the facts. And that formula, I'll just read it out. So after lengthy negotiations, the Department of the Environment, which owned the land, agreed that liability under the earlier leases for additional rent on tobacco duty, and I mentioned GST, but it's tobacco duty here, could be commuted by a payment of a lump sum based on 6 times the amount of additional rent due on tobacco duty for the year ending July 31st, 1963. And therefore, they have changed the lease, right? The terms of the lease. The question now was whether this lump sum that was paid by the taxpayers to change the terms of the lease, would that be capital expenditure or revenue expenditure, right? And the court said we will approach this case in the following way. We'll ask, what's the capital asset in this case? And the court said the capital asset in this case is a lease, right? That the lease is what's generating all the revenues for the shop. And they said a capital asset is its association, sorry. The capital asset is its association with expenditure aimed at acquiring, enhancing, or disposing of an asset. He emphasized, the Lord Wilberforce emphasized the presence of an asset as a key factor in determining capital expenditure. He said, capital expenditure as expenditure that is inherently tied to a capital asset, focusing on actions that directly impact the asset's existence, value, or utility. And therefore, costs, that is expenditure associated with removing or eliminating an asset that no longer serves its purpose or is detrimental to the business, are considered revenue capital expenditure. Expenditure aimed at improving an existing asset or enhancing its advantages are also considered as capital expenditure. And therefore, they said in this case, the lease is a capital asset. And in modifying the terms of the lease, making sure that it did not include the component of taxes, is basically ensuring that it is improving the asset and it's removing its disadvantageous parts. And therefore, it is capital expenditures related to the asset. There was some dissenting opinion that you can read on your own, with Lord Salmon saying that the classification of the lease, he had issues with even classifying the lease as a capital asset, because it was just a normal lease. It was not as if the lease was at rates that were below the market rate. He didn't even realize, he'd think that this would be a capital asset. But assuming it's a capital asset, anything that is done, and I'll now take you to the discussion of that case in note 19, where he said, note 19, and I'm just going to read out what he's saying. Yeah. Yes, Lord Wilberforce was saying, I think the key to the present case is to be found in those cases which have sought to identify an asset. In them, it seems reasonably logical to start with the assumption that money spent on the acquisition of the asset should be regarded as capital expenditure. Why? Because then you see an asset endures, right? It's across years. Extensions from this are first to regard money spent on getting rid of a disadvantageous asset. That's what they were trying to do here. They were trying to get rid of a disadvantageous asset, the lease, by modifying its terms. Extensions from this are first to regard money spent on getting rid of a disadvantageous asset as capital expenditure, and secondly, to regard money spent on improving the asset or making it more advantageous as capital expenditure. In the latter type of cases, it will have to be considered whether the expenditure has the result stated or whether it should be regarded as expenditure on maintenance or upkeep, which is revenue expenditure, and in some cases may prove difficult. It, that is expenditure in this case, is a case of once for all expenditure on a capital asset designed to make it more advantageous, by ensuring um, that they change the terms of the lease, that they ensure that the variable rent doesn't include taxes. It is true that the lease um, was non-assignable, so it had no balance sheet value before or after the modification, but it was nonetheless an asset and a valuable one for the appellant's trade. And if an asset was a capital asset, it appears to me to be impossible to divorce the payment from the lease and to regard it as simply a payment intended to increase the appellant's share of the profits. That it may have done, but the parties chose to do it through the medium of a lease, and therefore it should be considered as a capital expenditure. Right? I'll just stop here and ask if people have any questions, any comments. Um, I think Dutt has said if Anglo-Persian decided today in India, it would be deductible on account of revenue still under Section 28 ITA. That's correct. Because of the amendment to Section 28, it would be the case that those kind of payments would be deductible, not deductible, would be recognized as income under Section 28. Section 28 is about recognizing income, right? Business income. And it would be recognized as income under Section 28. Excellent. Any questions so far? Nothing for the class. So what we'll do now is we'll take a break and we'll come back in 10 minutes. We will come back at 10 o'clock exactly, and we'll continue with the rest of the case. Yep. Right. Yes. We'll come back at 10 o'clock. Thank you. Any questions? Any questions or any comments that you had? And then if not, we can start off on our work. Okay, so let me then um, go back to my slide deck. Excellent. So the next interesting case that we are dealing with is called Malalu versus Drummond. And this is the case. You will see the the note for this case. Sorry, just give me a second. You will see that in in the same note, which is note 18, English cases. And you will see that if you scroll down, you will notice that we have discussed in that note 18, we have discussed Tucker versus Granada, and then we go down and we discuss Anglo-Persian Oil Company, and we discuss then the Drummond case. And let me just read out the facts for you, right? In this case, the taxpayer was a practicing barrister, and in computing the profits of a profession for assessment income tax, claimed a deduction of expenses incurred in the replacement and cleaning of items of clothing which she wore in court and in chambers and on her way there as being expenditure wholly and exclusively laid out or expended for the purposes of a profession within the meaning of sections 130 clause A of the Income and Taxes Corporation Act 1970 of the UK. But notice here that the words that the expenditure has to be wholly and exclusively laid out or expended for the purpose of profession is the language you find in section 37 of the Income Tax Act 1961. So an identical expression. So it's important that we understand how to interpret it. The items of clothing were black suits, dresses, shoes, and tights and white shirts, and were unobtrusive in accordance with the notes for guidance on dress and coat issued by the Bar Council, um, for with which the taxpayer was required to comply. But these were also ordinary articles of apparel which could be worn in everyday life. The inspector of taxes disallowed the deduction for for the cleaning of the clothes, laundry, etc. Um, and the taxpayer appealed. The general commissioners found inter alia that the taxpayer had an ample private wardrobe, but she and that she would not have brought the disputed items, that's the dress for the court, but for the requirement of her profession, and that the preservation of warmth and decency was not a consideration which crossed her mind when she bought them. However, they concluded that in incurring the expense, the taxpayer had a dual purpose, namely to enable her to earn profits in her profession and to enable her to be properly clothed during the time she was engaged in her professional activity as a lawyer, and accordingly dismissed the appeal. On the taxpayer's appeal, the Slade justice reversed the commissioner's decision on the ground that their conclusion was not consistent with the findings, and the Court of Appeal then appealed to after the Court of Appeal, the decision came before the House of Lords, right? And the House of Lords, and what's the issue here? The issue is the revenue is claiming that you have a dual purpose for buying these clothes, right? Not just for the court, for your profession, but for yourself as well. And if you have a dual purpose, you cannot deduct it because the words are very clear. The words saying it has to be expended, any expenditure has to be expended wholly and exclusively. There can't be a dual purpose, wholly and exclusively for the purposes of the business or profession. And if you go to note 19, you realize that the decision is given there. And in note 19, we'll come to note 19, but if you just see the slide deck here, you will notice what we're saying. The court focused on determining the taxpayer's objective in incurring the expense, not merely its consequences. A private benefit might exist alongside a business purpose. An expenditure may be made exclusively to serve the purpose of the business, but it may also have a private advantage. And then they said that in this particular case, the taxpayer actually had a dual purpose, even though one of the purpose may not have been a particularly conscious motive. It could be unconscious as well. So they rejected the notion that the object of a taxpayer is inevitably limited to the particular conscious motive in mind at the moment of expenditure, right? And they said, the House of Lords said, and I'm now reading from note 19, to ascertain whether the money was expended to serve the purpose of the taxpayer's business, it is necessary to discover the taxpayer's object in making the expenditure. As the taxpayer's object in making the expenditure has to be found, it inevitably follows that, save in obvious cases that speak for themselves, the commissioners need to look into the taxpayer's mind at the moment when the expenditure is made. After events are irrelevant except as a reflection of the taxpayer's state of mind at the time of the expenditure. The object of the expenditure in making the expenditure must be distinguished from the effect of the expenditure. An expenditure may be made exclusively to serve the purpose of the business, but may have a private advantage. The existence of that private advantage does not necessarily preclude the exclusivity of the business purpose. We understand that, effect and purpose and effect. But now we come to the crux of the decision. But she needed clothes to travel to work and clothes to wear at work. And I think it is inescapable that one object, though not a conscious motive, now they're distinguishing between conscious and unconscious, and they're including unconscious motives as well. That one object, though not a conscious motive, was the provision of the clothing that she needed as a human being. I reject the notion that the object of a taxpayer is inevitably limited to the particular conscious motive in mind at the moment of expenditure. Of course, the motive of which the taxpayer is conscious is of a vital significance, but it is not inevitably the only object which the commissioners are entitled to find to exist. In my opinion, the commissioners were not only entitled to reach the conclusion that the taxpayer's object was both to serve the purposes of her profession and also to serve her personal purposes, but I myself would have found it impossible to reach any other conclusion. Let me repeat that. In my opinion, the commissioners were not only entitled to reach the conclusion that the taxpayer's object was both to serve the purposes of her profession and also to serve her personal purposes, that I myself would have found it impossible to reach any other conclusion. So this decision is important because it even says there could be, it's from the facts one can find, there could be unconscious objectives, and those unconscious objectives might also color our understanding of whether something is wholly and exclusively for purposes of the business or profession, right? So let me stop here and see if there's anything that anybody has a doubt, questions, comments. Let's see if anybody's saying anything. All right, so then shall we move on to the next case? So far we have done English cases on the difference between capital revenue expenditure, and we did the Anglo-Persian case with the Dracos of Granada case. And then we have talked about the Drummond case, which is not about the difference between capital revenue expenditure, but it's about whether an expenditure can be considered as wholly and exclusively for purposes of the business, right? So the other, as I said, Section 37 has twin components. Section 37 says that expenditures can be deductible, but it is not deductible if it's a capital expenditure, and we saw cases there. And it's also not deductible if it is not wholly and exclusively for the purposes of the business or profession. And we noticed some case law regarding that as well. Now we go to the next case, where first I'm going to talk about the case a little bit. And then I'm going to ask you to do a little bit of homework for me right now and give me your thoughts. This is an Indian case. This is called the Honda Seal Cars India Limited, was a CIT. And the question there was whether a technical fee paid by Honda's Indian joint venture to its Japanese parent company is a revenue expenditure or a capital expenditure. So, was it an enduring benefit, thus qualifying as capital expenditure, or merely facilitated ongoing operations, thus being revenue expenditure? And the court here ruled in favor of classifying the payment as capital expenditure because they said the payment was essential to establishing the entire manufacturing operation and not merely improving an existing one. This is what I want you to do now, right? I want you to go through this case. This is a fairly important case and it's a long case. I want you to go through this case for me. This case is in note 20. Note 20 begins with the Oberoi Hotel case, and after the Oberoi Hotels case, we come to the Honda Seal case. I want you to go through the case right now. I want all the students here to go through the case right now and tell me a bit more about the reasoning of the court. Why did the court reason in the way it reasoned here? It said it classified the payment as capital expenditure. What were the detailed reasons for the court classifying for its decision for the court classifying the payment as capital expenditure? I want you to go through the Honda Seal case. It's a fairly important case here with me. I'll give you some time and you'll have to go through it yourself. And then when I come back, you'll have to give me in succinct form what you how you understood what you understood was the court's reasoning in coming to this judgment, right? And the Honda Seal case is in note 20. It's I've given you several paragraphs from it. I think I've given you about 25 paragraphs from it. And I want you to go through those paras and come up with an answer. The question for the class is what was the court's reasoning in coming to its decision? How did the court arrive at this decision that this payment was a capital expenditure and not a revenue expenditure? So from now on, I'm going to ask you to do a series of class exercises so that we get some understanding of what's happening. Let's start with Honda Seal. This class exercise is not about the decision. We know the decision already. We know that it was considered as capital expenditure. I want to know the reasons behind it, and I want to know the detailed reasons behind it. All right. So I'll come back at let's say 10:30. I'll come back at 10:30, and you must then tell me what the reasons were. Yeah. Um, Everybody got that? Yes. Now, before that, I think Dutt was asking, did the court allow her to deduct the expenses for the not for the clothes? That this was a deduction for cleaning the clothes, expenses in cleaning and replacing her clothes. That expense was not considered as deductible because it was not wholly and exclusively for purposes of her business. They said, in addition to a conscious motive of going to court, there was an unconscious motive of also using it for, because it was just another set of clothes. It was sober, but it was another set of clothes, right? It wasn't, it's not like a special clothes that cannot be worn outside of court, right? So, but the interesting thing about this case was that it was talking about conscious and unconscious motives and taking that into account in coming to a decision. Okay, so I'll come back at 10:30, and I need everybody to be on top of this. You have to do some work right now for me and tell me how you understood the court's reasoning. How did the court arrive at its decision in Honda Steel that it was a capital expenditure? Okay, all right. Yes, so I'll come back by 10:30. I need an answer. Yep. Okay, I'm back. I hope that some of you have answers for me. Vivek has written, I couldn't understand, was the cleaning of clothes taxable or not? The the question was not whether something was taxable or not. The question was whether the expenditure that was incurred on the cleaning of clothes was deductible or not for tax purposes, right? Was it an expenditure? Suppose the lawyer was earning a certain amount of money. Could she then deduct from that amount of money that she was earning the money that she expended on replacing and repairing and laundry expenses for her clothes? And the answer was no. And the reason is that the court said that this wasn't money that was expended wholly and exclusively for purposes of her profession. That in addition to her conscious motive, which was to comply with the bar standards of clothing for the courts, there was an unconscious motive to just use it for her regular purposes. And therefore, there was a dual motive or a dual purpose. And when there is a dual purpose, you can't be allowed to deduct those expenses. Yeah. So Vivek, I hope I have understood. I mean, I have answered your question. And let's now get back to the Honda Seal case. Who's going to start me off on that? Yeah. Who's going to work with me? As I told you, we're doing it only so that you are able to do some interactions in the tax class, and it's less tedious, and you learn better that way, right? So don't worry about getting it wrong. That's not even the purpose of what we're doing here. Yes. So who's going to start? Who wants to begin? Uh, I think it might be easier here if you can speak, if somebody can speak. Yeah. And if I can encourage somebody to speak, it might be better. And by the way, there are people here who haven't, I mean, the people who usually say something or write something, and then the people who don't. So may I please encourage other people also to talk. Remember that in this course, we have lawyers, non lawyers, accountants, non accountants, business managers, people from all over the place. We are lending this to a diversity of views, right? So don't worry about what your view is or how it relates to the case. I want to just hear you, or if you want to chat, that's fine as well. But in this particular instance, it may be easier if we are able to hear you. Please, anybody. Yeah, we have about 25 minutes left, I think. So we should make the best of it. Yeah. So that says that it's capital expenditure because the joint venture was not in existence at the time of the payment, that this was starting a business from scratch. A new business had to be created for automobiles. A business was already in existence for other things, scooters, two wheelers, etc. Therefore, the expenditures, yes, that's right, were for an enduring benefit to create, well, I don't know about to create a new business, that not a new asset, because this all these rights that were transferred to the JV were not assets, right? They were just royalty payments, right? Technical know-hows, and so the JV did not own any asset in the end, but what it did get were something that were enduring and of a permanent nature, because it helped the JV in building up an asset and building up a business, and therefore there was some enduring benefit, and therefore it was capital expenditure. So let's go through this case. You already know the facts, but let me see. I'm just scrolling down the case for you, since and trying to make you see um, if um, if I can make you understand where the case is coming from. Para 11, the court says, a reading of the TCA, which was the agreement under which the royalty payments and the know-how payments were being made. Um, it was known as the Technical Collaboration Agreement. And a reading of the technical collaboration agreement would bring out the following pertinent aspects. The appellant was granted indivisible and non-transferable right to manufacture in India the range of products using the know-how supplied by HMCL. And as we know that HMCL was a Japanese company. The appellant had, during the currency of the agreement, only the right to assess the manufacturing know-how and technology that was owned by the Japanese company. There was no transfer of the know-how technology in favor of the appellant as in the Indian joint venture, and the proprietary rights therein always vested in HMCL. The appellant was to keep the know-how technology confidential and was barred from assigning the same to um, anybody else, to a third party. The agreement was for a period of 10 years and was renewable at the option of the parties. On the expiry of the agreement, the appellant, that is the Indian joint venture, was prohibited from using the know-how technology and was duty-bound to return all copies of the drawings, designs, etc., made available by the Japanese company under the agreement. Now the court is saying, if the aforesaid factors were taken in isolation, probably the claim of the SSC, which is that this is revenue expenditure, may be justified. And then it goes through, it says distinction between capital and revenue expenditure with reference to the acquisition of technical information and know-how has been spelled out by this court as well as by high courts in a series of cases. Primary test, which is adopted to differentiate between capital and revenue expenditure, remains the same, namely the enduring nature test. It means where the expenditure is incurred, which gives enduring benefit, it will be treated as capital expenditure. That is the enduring nature test, means where the expenditure is incurred, which gives enduring benefit, it will be treated as capital expenditure. In contradiction to the cases where expenditure of concurrent and recurring nature is incurred, and the latter would belong to the revenue field. And then it talks about the nature of in para 14, it talks about the nature of intangible assets, etc. Then in para 16, it discusses a case, and this is a fairly important case in Indian case law, which is called the Commission of Income Tax versus SEBA India Limited. In that case, the SSC had procured know-how in the form of processes, formulae, scientific data, working, prescription, and other intellectual property rights developed by a Swiss company to produce licensed preparations and to promote their sale in India. Now, in spite of the fact that the Swiss company had granted to the Indian SSC full and sole rights and license to make use, exercise, vend the inventions, etc., this court held that what was conferred was a mere right to use. The Indian SSC, it was observed, was not entitled to exclusive rights to patents, trademarks, etc. It closes that paragraph by saying it is not a case of a transfer of intellectual rights once and for all. All the expenditure incurred was revenue in nature. In para 18, the court discusses a very important, probably the most important case on capital versus revenue expenditure in the Indian context, called the Alembic Chemical Works Limited versus Commission of Income Tax, Gujarat. The SSC was engaged in a manufacture of antibiotics and pharmaceuticals on the basis of license, which is granted to it by the government for manufacture of antibiotic, penicillin, etc. It entered into an agreement with the Japanese company for supply of requisite know-how so as to achieve substantially high level of performance of production with the aid of better technology and process of fermentation and those kind of things. In this case, the court held when it finally reached the Supreme Court that this was the following in para 19, that this was the following principles to distinguish between capital expenditure and revenue expenditure. And they gave, if you notice, in para 19, while discussing the Alembic case, the Alembic Chemical Works case, three factors, A, B, and C. First, When an expenditure is made not only once and for all, but with a view to bringing into existence an asset or an advantage for the enduring benefit of trade, I think that there is very good reason, and then in brackets, in the absence of special circumstances leading to an opposite conclusion, for treating such an expenditure as properly attributable not to revenue but to capital. If an expenditure is made for acquiring or bringing into existence an asset or advantage for the enduring benefit of the business, it is properly attributable to capital and is of the nature of capital expenditure. If, on the other hand, it is made not for the purpose of bringing into existence any such asset or advantage, but for running the business or working it with a view to produce the profits, it's revenue expenditure. The aim and object of the expenditure would determine the character of the expenditure, whether it's a capital expenditure or a revenue expenditure. So it was also held in that case that three aspects should be considered: the character of the advantage sought, and in this, its lasting qualities may play a lot, the manner in which it is to be used, relied upon, or enjoyed, and in this and in under the former head, recurrence may play its part, and the means adopted to obtain it. Now, and then after they discuss this, they they come um, to their facts here. Um, Para 24. When we apply the aforesaid parameters, aforesaid ratio, to the facts of the present case, the conclusion drawn by the High Court that expenditure incurred was of a capital nature appears to be unblemished. Admittedly, there was no existing business, that has already pointed that out, and thus question of improving the existing technical know-how by borrowing the technical know-how of HMCL Japan did not arise. The SSC was not in existence at all, and it was a result of a joint venture of Japan and India. The very purpose of the agreement between the two companies was to set up a joint venture and to establish a unit. As a result of this agreement, SSC company was incorporated, uh, which entered into a TCA in question for technical collaboration. This technical collaboration included not only transfer of technical information but also complete assistance, actual, factual, on the spot, for establishment of plant machinery, etc., to bring into existence manufacturing unit for the products. Thus, a new business was set up with the technical know-how provided by Japan, and the lump sum royalty, though in 5 installments, was paid therefore. No doubt this technical know-how is for a limited period, which is for the tenure of the agreement. However, it is important to note that in case of the termination of the agreement, joint venture itself would come to an end, and there may not be any further continuation of manufacture of product with technical know-how of foreign collaborator. Thus, the High Court has rightly observed that the virtually life of manufacture of product in the plant and machinery establishes, with assistance of foreign companies, coexistence with the agreement, right? And the agreement is framed in a manner so as to give a color of license for a limited period having no enduring nature. But when a close scrutiny into the agreement is made, it shows otherwise, right? It is significant to note that the agreement provides that in the event of expiration or otherwise termination, the SSA shall discontinue the manufacture, sale, and other disposal of products. All these things shall be at the option of the licensor. In other words, licensee in such contingency would hand over unsold product and parts to the licensor for sale by him, right? The the agreement also has a clause of renewal, which, in our view, in totality of terms and conditions, will make the unit continue so long as the manufacture of product in plant and machinery established with aid and assistance of foreign company will continue. Right? Since it is found, and this is a critical point, since it is found that the agreement in question was crucial for setting up of the plant project in question for manufacturing of the goods, the expenditure in the form of royalty paid would be in the nature of capital expenditure and not revenue expenditure. Um, and that's an important point that you must think about. Even if it's, say, for royalty for a limited period of time, if it is really meant to set up a business, um, to create a new business, as Dutt has called it, and therefore has an enduring benefit, then it will be considered as revenue, as capital expenditure, right? And remember, this was for a period of 10 years. What is the takeaway from this case for us? I think the takeaway from this case for us is really interesting, because what we're saying is, in this case, for example, the assessee did not really acquire any particular asset, right? They were just making royalty payments. Even though they did that, and even though it was only for 10 years, it was considered as a capital expenditure and not as a revenue expenditure. Um, Even though there was no, in the end, there was no asset owned by the assessee as a result of its expenditure, the fact that whatever expenditure it did had an enduring benefit, it actually, and in the form of a new business being created, it was considered as a capital expenditure. So, my friends, that's the ratio of the case, and you must read this case very carefully because of all the case law that's in it. Now, one question I have for the students, and hopefully you should be able to answer this for me. Um, if you go to point 5, para 5 in this judgment, it says that this total share capital of HSCIL slash SSE, that is the joint venture Indian company, the total share capital was 36 crore shares, out of which 99% of the shares were held by the Japanese company and about 1% was held by the Indian company. In other words, joint venture was almost owned exclusively by HMCL Japan, having around 99% shares, and SEAL India, which is a local Indian company, only owned 1%. Um, why is this fact relevant? Or is this what's happening here in this case? What's the tax planning that's happening here in this case? Anybody has any thoughts? Do you want to think a little bit more about this for me? Yeah. What exactly is happening? So this is where we try to go a little bit beyond, you know, kind of sometimes the distinctions between capital and revenue expenditure and all this case law that's there. It has its own tediousness, right? It can become a bit boring. But um, what might be interesting is how does that play out within the overall tax planning of the taxpayer, right? So any thoughts on that on well, I mean, you might think of it as a PE, but which is a permanent establishment, which is an international tax concept, and that is asking whether this joint venture is a permanent establishment or not. And there may be some views as to whether it's a permanent establishment or not, but that's not what I was looking for. That's an international tax question, but that's not what we are looking for here. By the way, we'll come to the idea of permanent establishments when we discuss international tax law in this course, but not right now. Right now, we're not discussing international tax law. But let's understand this point a bit better. But for that, I need you to think a little bit about why did the Japanese. Let me put it this way. I think a better way of understanding this is the following. Right? Let's understand the Honda Seal case in a slightly different way, right? Let's start with the structuring of the business. The Japanese company could have just opened a factory in India and started and used its technology to start manufacturing. It's got its royalties, it's got its technological know-how, it's got its patents. It can run a factory on its own in India, right? So it could start a factory. Assume that it is capable of starting a factory in India. Assume that the regulatory requirements allow a Japanese company to come to India and start a factory. But that's not what it's doing, right? What it's doing is it's entering into a joint venture with an Indian company, and in which this joint venture is virtually owned by it because it owns 99% of this Indian company, and only 1% is owned by its Indian partner, and then it's doing business in India. Why would it structure its operations in this manner? It's an interesting question for us, no, from a tax point of view, right? Somebody would advise them to do it. An interesting question from a tax point of view. And we can only speculate because the court is not talking about that, right? And yes, so Indulekha is pointing out what I was trying to get at here. Indulekha is written that setting up a plant is completely capital expenditure, while giving royalty for running business can be revenue deductions. Hence this JV, and that's a very good point, Indulekha. So let me state it in a different fashion. But what Indulekha is saying is absolutely right. The problem now for the Japanese company is whatever profits it's going to make from its Indian business, those profits have to be minimized for tax purposes as much as possible. One way to minimize the profits for tax purpose is to say that these profits were made out of technological know-how, and therefore the expenses for technological know-how should be deducted from these profits. But it can't be done in the straightforward fashion, because suppose the Japanese company has know-how and it's using its know-how because it already owns the patents and ownership of this know-how. If it's using that know-how for its own business, it won't be able to expense it. But it will be able to expense it if it creates an Indian company, a separate company, and that company pays this Japanese company royalty payments for technology. Right? If that happens, then you can reduce, because you can deduct those royalties. If you claim the royalty payments, if you claim it successfully as revenue expenditure, you can reduce your Indian profits, whatever profits you make out of manufacturing in the Indian company, in the Indian factory. You can reduce those profits, those revenues, by deducting from them the royalty payments that you have made to your Japanese company. And if you're able to do that, then your income in India for Indian tax purposes would be reduced to that extent. That is what the Japanese company, I believe, was trying to do. Right? It said, if I set up a company, if I set up a factory myself, how will I be able to deduct these payments? I won't be able to do it, right? But if I set it up through an Indian company, and then let the Indian company charge me, Indian company pay me for all the scientific know-how that I'm sending to the Indian company, that might be considered as revenue expenditure and would be deductible from the profits of the Indian company. That's what the Japanese company was trying to do, but the Indian Supreme Court came in the way and said, no, that's not good. These deductions that you're making, this is a capital expenditure. There's not a revenue expenditure, because you're basically setting up a business, and therefore you would not be able to tax it. You would not be able to expense it. Now, of course, the other issue is that's all right, but if it's considered as capital expenditure, but can the Indian company then do something can they use the capital expenditure to reduce its tax for Indian purposes by saying something like depreciation or amortization? That's the only way out now for the Indian company to use these expenses. Unfortunately, I'm not sure whether in this case these royalty payments could be amortized or depreciated. That's the other problem. For depreciation or amortization to work, they have to fulfill the conditions in Section 32 and other sections, and we'll have to see whether the Indian company could do that. So it's not a straightforward answer. In other words, not all capital expenditure is automatically subject to depreciation or amortization. You will have to fulfill the statutory conditions that are mentioned in the Income Tax Act. So that's why this case is interesting for me, because this case is interesting because I think once you read the case quite closely, and I want all of you to read the case quite closely, we realize that there may be some tax planning involved here in setting up a 99% owned Indian subsidiary in India, and then making that Indian subsidiary pay royalty payments to the parent and then claiming that those royalty payments are revenue expenditure, and then reducing the Indian subsidiaries' profits by claiming that. But that tax planning didn't work in this case. But it'd be interesting for us to see how that we went into that. Great. So, any other? So, I'm very happy to hear from the students, but I want more. I want more students to talk or to message me. It's, as I said, don't be shy. It's important that we hear from everyone. I think I've heard so far from Vivek and from Dutt and from Indulekha, but I haven't heard from others. It'll be great for me to also get to know you better, to hear from you. So please do that. I have two more problems here, but I noticed that we are already at 10:55. So I don't think I should go to the problems right now. Though we can pick that up in the next session, because the next session is also on revenue versus capital expenditure, except that we'll be doing some more cases, and some more Indian cases there. So that we'll pick it up. We'll pick up those problems over there. But so that's not a problem. But I want to know anything else that you want to ask about the course or about the tax course itself. We have about 4 minutes left. Is there anything else that you wanted to know? I think I have from Manoj Kumar. I have a query which is, sir, I think the moot question in this case is, in the case of technical information and know-how, having regard to the unique characteristics, the questions that need to be posed for determining the nature of such an expenditure are also of a different nature. In case where there is a transfer of ownership in the intellectual property rights or the license, it would clearly be a capital expenditure. That's absolutely right, Manoj. In case there is a transfer of ownership, and by transfer of ownership, what we mean is we're not just transferring technology, we are transferring the right to use this technology to somebody else, right? And that would be a transfer of ownership for purposes of the act, and then it will clearly be a capital expenditure. And in this case, in the Honda Seal case, there was no transfer of ownership of intangible property, right? There was only a fixed term uh, transfer of rights, and that was only for 10 years, and that was just a royalty payment. Even then, the court said that because these payments basically set up a new business, had an enduring benefit, it would be considered as capital expenditure. So they didn't own the intellectual property here. The persons paying for intellectual property didn't own it in the end. But even then, it was considered that those payments were capital expenditure. Yeah, so that's the interesting thing about the Honda Seal case. All right. Any other questions, comments, any doubts that anybody has? Anything they want to talk about the course? Any other? Somebody had a question about assessments and whether they should read the course materials for the assessments. You should read the course materials, but the course materials contains a lot of things, right? And you should read the stuff that I ask you to read. So if I ask you to, for example, whether whatever is covered here, that coverage in the course materials has to be read. So, for example, if I've done the Honda Seal case here, and you must read the Honda Seal case excerpts in the course materials, right? If I've done Malulu versus Drummond, if I've done Tucker versus Canada, you must go back and read those cases. So whatever cases we cover here, whatever material we cover here, whatever cases we cover here, you must read it in the course materials. That is, maybe that's not done elsewhere, but at NLS we are very particular that we learn the law in this manner, and we don't make a distinction between online and offline. Wherever we teach, we do it the same way. So we have the same rigor for you as well. Okay, I think we're at the end of our class. So thank you very much, and see you soon for the next session on capital versus revenue expenditure. Okay, thank you. Take care. Have a nice weekend.
Thank you, sir.
Thank you.